Futuregrowth Asset Management is saying it's going to wind down its holding of bonds in Capitec Bank, African Bank Investments and other unsecured lenders over the next 3 to 4 years. So joining us in studio now to look at the rationale behind, they're not saying it's panic selling, but this strategy right now, the disinvestment. Andrew Cantor, CIO of Futuregrowth Asset Management. Thanks for joining us today, Andrew. So as I was saying, you're not saying it's like panic selling right now, but you are reducing your exposure. Has your investment thesis around the banks changed dramatically?
Okay, it's not an investment thesis argument is the point. I think the genesis of this is we run developmental portfolios, clients who invest in portfolios that have socially responsible mandates, positive developmental impact. And as we followed the micro-lending story from the Grameen Bank and the Nobel Prize, it became the darling. Micro-lending became the darling of the international community, including us. We did quite a lot of funding into the micro-lending sector. But now the tide has turned. The time has come to look objectively at this, and all of us know what's going on there out in the streets in South Africa with the excess in the micro-lending industry. And I'm not naming names. It's not important who the names are. In fact, when we talk about letting these funds wind down their exposure, we name names like Capitec and Able. Those are the good guys. These are the people we have lent money to because we believe they do it in an ethical and proper way. So this isn't an investment thesis thing. This is a matter of not being willing to stand up in front of my clients in developmental portfolios only. And I'm being clear, only in our developmental funds, not across all of future growth funds, and certainly this has nothing to do with old mutuals funds, and saying, I can't defend microlending anymore as an industry. It's not developmental like low-income housing. It's not the SMME finance that Mohammed Yunus is talking about, which is really what Grameen Bank is about. So that's the key message.
You talk about this bad dynamic playing out where you've got bad players lending to some of the clients of the likes of Capitec and Able, and they're having to step in and provide more debt, and it's a negative feedback cycle right now. So what's gone wrong in the whole model here in South Africa?
Well, okay, so I mean, this is a difficult story because the National Credit Act, the NCA, was it's a fantastic form of governance, forward thinking by the government about how to get things right in the lending industry in South Africa. Unfortunately, the perverse effects have been it creates a national credit register that everybody can see. All the lenders can see who has capacity to borrow debt, and they can call you and say, hey, I see you haven't borrowed as much as you possibly can. Let me make another loan to you. Let me consolidate all your debt into a 5-year, 50,000 Rand, 32% loan plus fees. And that's what's happening. So this good thing has been having some negative consequences. And that's what's happening. It's not a competition to lower rates to the consumers. It's a competition to lock the consumers into long-term debt. And that is, to me, a form of financial enslavement. Because those people will never get out of that debt. And that's capacity they could have used to walk into a bank and buy a house, or perhaps pay for the kids' education. And nobody knows where that money is going. It could be going for shirts and shoes and food. And I've got nothing against food, but you shouldn't borrow money for 5 years to do it.
I mean, it's a very technical discussion to compare, say, a Grameen Bank with an Able and the model that they've had. But Grameen has been so successful. And perhaps part of that is the engagement that they have with the clients. They go to their house, they teach them how to be entrepreneurs, they teach them about handling money. And perhaps that's a very important missing link in the model here in South Africa, where you've got still people who have an immature understanding of how to manage money and especially debt in their lives.
I don't think it's technical at all, because the Grameen Bank model is an SME funding model. Say, yes, you will borrow $10 today, you must pay back 20 tomorrow. That's 100% interest rate per day, which is outrageously high, but it's for working capital. It's so that entrepreneur could buy something and sell it for a margin even after interest costs. What we're talking about in the personal unsecured lending market, which is what I'm focusing on, is loans that are just being consumed for consumer goods. It is not working capital, it's not profitable, and therefore it is impoverishing.
What's the value of exposure that Old Mutual has to these banks?
Well, as I say, I can't speak for Old Mutual. I can only speak for Futuregrowth.
So
if I think, and again, I'm only speaking about our developmental portfolios, and I'll come back to it, but I really want to be clear. It's not a panic sell. We're not exiting. We're not saying these are all bad people. We'll never lend to them. If business models change, if dynamics change, if they go into low-income housing lending rather than personal unsecured lending, we will flip-flop this decision. So in our developmental portfolios, it's probably about R1 billion overall, and that will be allowed to wind down organically over the coming 4 or 5 years.
And just before we wrap this up, what is the better investment story if we're looking at developmental funding? Because as you say, you keep highlighting in that portfolio.